The average new car in America now costs over $50,000. The median worker earns about $65,000 a year. That means one vehicle now consumes nearly an entire year of gross income before taxes, insurance, fuel, or repairs. Dealerships are packed with cars that sit 500 to 800 days unsold, while buyers disappear under 8-4-month loans. $1,000 plus monthly payments and interest costs that quietly add $30,000 to $40,000 to a single purchase. This isn't a slowdown. It's a market rupture where prices broke away from reality and the system kept selling anyway. What happens when prices detach from income is not panic buying, it's paralysis. And that paralysis is now visible in plain sight on dealership lots across the country. Inventory is rising, not because factories suddenly overproduced, but because buyers stopped absorbing the product. According to industry data, total new vehicle day supply has surged well above pre-pandemic norms, with several domestic brands drifting past 90 to 120 days of supply, a level historically associated with forced discounting and margin stress. Some models are no longer measured in weeks or months, but in years sitting idle. This buildup is especially concentrated among high-priced mainstream vehicles that were positioned as everyday transportation. Full-size trucks and SUVs, once volume anchors, now represent $60,000 to $80,000 commitments before financing costs. When demand slows even slightly, these vehicles don't clear. They stack. Each unsold unit quietly drains capital through floor plan interest, insurance, depreciation, and opportunity cost. At current rates, dealers are paying thousands of dollars per vehicle per year just to keep inventory parked and insured. The warning signs are already flashing. Certain manufacturers have recorded double-digit percentage increases in inventory year over year, even as incentives quietly expand behind the scenes. This is no longer strategic stockpiling. It's imbalance. The system was calibrated for a consumer willing to stretch payments indefinitely. When that consumer hit financial limits, the pipeline didn't stop. It backed up. And this isn't evenly distributed. Brands with weaker reliability reputations and higher average transaction prices are absorbing the pressure first. Vehicles linger long enough to require reconditioning, battery replacements, tire dry rot fixes, and software updates, costs that further erode margins. A car that doesn't sell quickly becomes a liability, not an asset. Every additional day on the lot pushes its true break-even price lower, even as the sticker stays artificially high. This is how the crisis forms silently. Not with empty lots, but with too many cars no one can rationally buy. Inventory didn't flood the market overnight. It accumulated gradually as affordability collapsed one buyer at a time. And once inventory overwhelms demand, pricing power vanishes, setting the stage for the next fracture in the system. Once inventory stops moving, the next question becomes unavoidable. Who was this priced for? The answer exposes the core failure of the market. Vehicle pricing did not rise alongside income. It ran far ahead of it. The average new car now exceeds $50,000, while the median U.S. worker earns roughly $65,000 a year before taxes. That gap is not cosmetic. It means a single purchase now demands 70 to 80% of annual gross income before insurance, fuel, registration, or repairs are even considered. At that ratio, demand doesn't slow, it collapses. This is where the math breaks. A $50,000 vehicle financed at current rates produces monthly payments that routinely exceed $800 to $1,100, even with long loan terms. Stretch the loan to 72 or 84 months, and the payment shrinks slightly, but the total cost explodes. Buyers quietly commit to $65,000 to $75,000 all-in for a depreciating asset, while wages grow at a fraction of that pace. The system survives only as long as buyers agree to ignore the total number, but households are no longer able to compartmentalize. Insurance premiums have surged 20 to 30% in many states. Routine repairs increasingly cost hundreds or thousands due to electronic systems and part bundling. Fuel, registration, and taxes layer on top. Transportation has shifted from a manageable expense into a structural monthly burden that competes directly with housing, food, and healthcare. That trade-off is where demand finally snaps. This explains why inventory now stalls. The market didn't misread preferences, it mispriced reality. Automakers assumed buyers would permanently accept higher payments, longer terms, and greater risk. That assumption collided with fixed incomes and rising living costs. When affordability fails at the household level, no amount of marketing can revive demand. And crucially, this breakdown doesn't begin at the luxury tier. It starts when mainstream vehicles cross psychological and financial thresholds that consumers cannot rationalize. Once that line is crossed, buyers don't downgrade, they disengage. That disengagement pushes them toward alternatives where the illusion of affordability is supposed to reappear, but doesn't. When new vehicles cross the affordability line, demand didn't disappear. It redirected. Buyers moved downstream, searching for relief in the used market. That shift should have created balance. Instead, it exposed the next distortion. Used cars were never allowed to normalize. They were repriced upward to absorb desperation, not value. The result is a market where cheap no longer exists. Only less expensive debt and higher risk. Used vehicle prices remain historically elevated despite easing supply. 10 to 15-year-old cars with 150,000 to 200,000 meters are routinely listed between $6,000 and $10,000, a level that would have been unthinkable a decade ago. In many segments, the price gap between lightly used and new has collapsed to $1,000 to $3,000, eliminating the traditional incentive to accept wear, mileage, and uncertainty. When depreciation stops functioning, the market stops clearing. This inflation is not driven by quality or scarcity, it is driven by cost transfer. Dealers acquire high-mileage vehicles at auction for a fraction of their listing price, then reintroduce them to consumers stripped of protection. No warranty, no price buffer, no margin for failure. Mechanical risk that once belonged to sellers is now pushed entirely onto buyers. A single transmission or electronics failure can exceed $4,000 to $7,000. Instantly exceeding the remaining value of the vehicle itself. The math becomes even harsher under financing. Used car interest rates routinely exceed 8% to 12%, meaning a $9,000 vehicle can cost $12,000 to $14,000 over the life of the loan for a product already near the end of its usable lifespan. This is not affordability. It is delayed impact. Buyers are not saving money. They are front-loading risk in exchange for lower monthly numbers. What this creates is a trap, not a solution. New cars are blocked by price. Used cars are blocked by fragility. The middle ground, once the backbone of personal transportation, has been hollowed out. The market now offers two options: long-term debt on overpriced new inventory or short-term survival on overvalued used vehicles with no safety net. This failure feeds directly back into stalled inventory. When neither option makes rational sense, buyers don't compromise. They pause. That pause is why cars remain parked, unsold, depreciating in silence. And as consumers retreat further, the system is forced to rely not on affordability, but on persuasion, shifting the pressure from pricing into psychology. When buyers hesitate because the numbers no longer make sense, the system doesn't correct prices, it changes tactics. This is where stalled demand is converted into psychological pressure. As affordability collapses, the sales process shifts away from transparency and toward behavioral framing designed to keep transactions alive even when the math fails. The first lever is language. Price becomes value. Cost becomes investment. A binding obligation becomes an agreement. These substitutions are not accidental. They are engineered to soften resistance at the exact moment a buyer confronts a 5-figure commitment. Behavioral studies consistently show that reframing financial terms can materially increase compliance even when underlying costs remain unchanged. In high-ticket retail, that effect is amplified. When a number exceeds $50,000, words become the buffer. The second lever is information control. Out-the-door pricing is delayed, fragmented, or withheld entirely until buyers are physically present. This is not about calculation. Taxes and fees are easily estimated. It is about leverage. Once a consumer has invested time, travel, and attention, the probability of conversion rises sharply. Sales environments are designed around this reality. The goal is not clarity. It is commitment escalation. The third lever is financing choreography. Monthly payments are foregrounded while totals disappear. A $900 payment sounds manageable when detached from a $70,000 all-in obligation. Interest is normalized. Loan duration is softened. The buyer is guided away from cumulative cost and toward immediate affordability cues, even as rates quietly add tens of thousands of dollars over time. The transaction survives not because it is rational, but because it is reframed as survivable. The fourth lever is urgency without substance, limited availability, expiring incentives. This unit won't last. These prompts persist even as inventory sits idle for months. Scarcity is simulated in an environment of excess. The contradiction doesn't matter. Repetition conditions response. This is how vehicles that outpace income still leave the lot. Not through alignment with wages, but through managed perception. The process substitutes persuasion for affordability and control for trust. And as buyers grow more resistant, the tactics intensify, not retreat. But persuasion has limits. When households reach financial saturation, language cannot close the gap. At that point, the system leans harder on the final mechanism holding it together: extended credit, where the illusion of affordability is stretched across time and the real cost is postponed rather than solved. When persuasion reaches its limit, the system leans on time. Financing becomes the final bridge between unaffordable prices and reluctant buyers. The illusion works by stretching obligations so thin that the true weight disappears from view. What looks like access is actually delay, and what feels manageable is simply extended exposure. Auto loans that once averaged 48 to 60 months are now routinely written at 72 and 84 months, pushing repayment horizons beyond the functional lifespan of many vehicles. This is not accidental. Lengthening terms reduces the visible monthly number while inflating the total cost beyond recognition. A $55,000 vehicle financed at current rates can quietly become a $75,000 to $85,000 commitment with interest alone, absorbing $25,000 to $35,000 over the life of the loan. The car depreciates immediately, the debt does not. The framing is deliberate. Payments are discussed in isolation, stripped of duration and cumulative impact. 7 years becomes 84 months. Interest is folded into the background. The buyer is encouraged to focus on whether the payment fits this month, not whether the obligation still makes sense 5 years from now. This is how affordability is simulated in a market where prices already broke the income ceiling. Negative equity compounds the problem. As values fall faster than balances decline, borrowers remain upside down for most of the loan term. Trade-ins no longer reset the cycle. They roll the deficit forward, embedding old debt into new contracts. This creates a cascading effect where each purchase increases dependency on longer terms and higher risk tolerance. Mobility becomes conditional on continuous refinancing. The fragility is structural. A single disruption, job loss, medical expense, insurance spike can destabilize the entire arrangement. Vehicles financed this way are not owned. They are temporarily occupied under debt supervision. Missed payments trigger rapid consequences because lenders understand the underlying risk. The system depends on uninterrupted cash flow from households already under pressure. This explains why financing is now the central sales instrument. It compensates for prices that consumers would reject outright if presented honestly. But time is not a solution, it is a postponement. Extending loans does not create affordability. It exports the problem into the future where depreciation, maintenance, and obsolescence collide with remaining balances. As these loans accumulate across millions of households, they don't just strain buyers. They destabilize inventory, resale values, and lender confidence. When debt becomes the only way to move product, the market is no longer functioning. It is surviving on borrowed time. Once debt is stretched across 7 years, durability should matter more than ever. Instead, the product itself has moved in the opposite direction. Modern vehicles are no longer designed to be maintained over time. They are designed to be replaced. This is where the financing illusion collides with engineering reality and the gap becomes impossible to ignore. Planned obsolescence is no longer subtle. Mechanical simplicity has been traded for tightly integrated systems that bundle minor failures into major replacements. Designed out, this shift transforms ownership economics. As vehicles age, repair costs do not rise gradually, they spike. Electronic modules, proprietary software locks, and dealer-only diagnostics turn routine maintenance into specialized intervention. Labor hours increase, parts availability narrows. What was once a $300 fix becomes a 4-figure decision point. For households already carrying long-term loans, this is where the math collapses again. Not at purchase, but mid-ownership. The parts pipeline reinforces the trap. Manufacturers discontinue components earlier, forcing full replacements or total loss scenarios. After just a few years, certain assemblies are no longer stocked, pushing owners towards secondary markets or total replacement. This compresses usable lifespan while loans remain outstanding. The result is a growing mismatch between how long a car can reasonably be kept and how long it is being paid for. Right-to-repair barriers intensify the pressure. Proprietary tools, restricted software access, and serialized components prevent independent repair. Even when mechanical solutions exist, consumers are locked out of fixing what they technically own. The cost is not just financial, it is strategic. When repair becomes impractical, replacement becomes the default outcome, exactly as intended. This design philosophy feeds directly back into inventory and pricing. Vehicles depreciate faster because future buyers understand the repair risk. Residual values weaken. Lenders respond with longer terms to mask declining durability. Dealers face slower turnover as consumers hesitate to commit to products that age poorly under debt. In this environment, high prices are no longer justified by longevity or serviceability. They are justified by forced cycles. When cars are engineered to expire sooner while loans extend longer, the market stops functioning as transportation and starts operating as extraction. And once buyers recognize that imbalance, discounts and persuasion lose their power because the problem is no longer the price. It is the product itself. When durability collapses and debt stretches longer than usefulness, price cuts are supposed to rescue demand. Instead, they are failing because discounts cannot repair a broken value proposition. Slashing numbers on the windshield does not change what buyers now understand. The total cost still doesn't make sense, and the risk hasn't gone away. Dealers are quietly cutting $5,000, $10,000, even $15,000 off sticker prices. Yet inventory continues to stagnate. Vehicles sit for hundreds of days, depreciating faster than incentives expand. This is not resistance to price. It is resistance to commitment. A discounted $60,000 vehicle is still a multi-year liability when insurance, interest, maintenance, and repair exposure are added back in. The math remains hostile even after the markdown. What discounts reveal is desperation, not opportunity. Historically, incentives restored balance when prices overshot temporarily. This time, pricing overshot structurally. Transaction prices were built on the assumption of permanent credit expansion, uninterrupted income, and rising residual values. When those assumptions failed, incentives became a bandage on a fracture. Buyers don't see savings. They see confirmation that prices were inflated to begin with. The credibility problem is growing. A vehicle marked down tens of thousands of dollars sends a signal that its original valuation was fictional. That erodes trust, not just demand. Consumers begin to ask why a product needed such aggressive correction, and whether future resale will collapse just as quickly. A discounted car today becomes tomorrow's depreciating anchor, and buyers are adjusting behavior accordingly. At the same time, incentives cannot offset financing reality. Interest rates remain elevated, and long loan terms magnify uncertainty. A $12,000 discount can be erased by interest over 72 or 84 months, especially when rates exceed 7 to 9%. From the buyer's perspective, the relief is cosmetic. The obligation remains long, inflexible, and exposed to economic shocks. There is also a product mismatch problem that discounts cannot solve. Many vehicles on lots are over-optioned, oversized, and technologically bloated for the buyers still left in the market. Price cuts do not remove complexity, reduce repair risk, or shorten loan duration. They simply compress margins while leaving the underlying objections intact. This is why inventory continues to age even as numbers fall. As discounts widen, they create a feedback loop. Buyers delay purchases, expecting deeper cuts. Dealers hesitate to slash further, fearing balance sheet damage. Inventory lingers. Carrying costs rise. The standoff intensifies. What should be a clearing mechanism becomes a signal of instability. This is the point where the market reveals its true condition. Discounts stop functioning as demand stimulants and start functioning as distress markers. They announce that the old pricing model is no longer defensible, yet cannot be abandoned without systemic consequences. And as that tension builds, the final outcome comes into view. Not a gentle adjustment, but a forced reset where prices, products, and the sales model itself are compelled to realign with reality. When discounts stop clearing inventory, the market reaches its final phase, forced realignment. At this stage, there are no cosmetic fixes left. The gap between price, income, durability, and debt has widened beyond persuasion. What follows is not a rebound, but a reset driven by arithmetic, not sentiment. The pressure points are converging simultaneously. Inventory levels remain elevated while turnover slows. Floor plan interest continues to accrue at rates that punish stagnation. A single unsold 60,000 vehicle can cost a dealer thousands of dollars per year just to hold even before depreciation is accounted for. Multiply that across hundreds of units and balance sheets begin to strain. This is why price cuts accelerated and why they still weren't enough. Carrying costs do not negotiate. At the same time, consumers have reached saturation. Household budgets are already absorbing elevated housing costs, insurance premiums, food inflation, and debt servicing. Transportation is no longer flexible spending. It is a fixed obligation competing with survival categories. When buyers disengage at scale, demand doesn't wait for incentives. It recedes structurally. That retreat is what inventory is now reflecting. The reset can only occur through one of three mechanisms, and none are painless. Prices must fall materially, not symbolically. Loan structures must compress, not stretch, or production must contract sharply enough to drain excess supply. Historically, this kind of imbalance resolves through a combination of all three. That process does not reward optimism. It rewards alignment. Manufacturers face the most difficult choice. Reducing prices undermines brand positioning and residual values. Reducing output threatens scale economics. Maintaining the status quo accelerates inventory decay. Each option imposes losses somewhere in the system. The question is no longer whether adjustment happens, but who absorbs it first. Dealerships are already absorbing the early impact. Margin compression, incentive dependency, and aging inventory expose weaknesses in a sales model built for perpetual turnover. When velocity slows, the model breaks. This is why pressure is building to simplify offerings, cut trims, and reintroduce genuinely affordable entry points. Not for marketing reasons, for survival. Financing will also be forced to recalibrate. Extended terms masked affordability only as long as confidence held. As defaults rise and resale values weaken, lenders tighten. When credit availability narrows, demand contracts further, accelerating the reset. Debt cannot be the primary engine of volume forever. Eventually, it becomes the constraint. The product itself must change. Vehicles engineered for disposability cannot coexist with 7-year obligations. Complexity without longevity collapses resale confidence. Repair hostility destroys ownership trust. These factors now feed directly into buying decisions. Consumers are no longer evaluating features alone. They're pricing risk over time. This is the end state the market is approaching, not collapse but correction. Not panic but reversion. The industry expanded pricing and debt far beyond what income, durability, and trust could support. That expansion phase is over. What remains is reconciliation with reality. The reset will not announce itself with headlines. It will show up quietly in smaller cars, shorter loans, lower margins, and abandoned inventory. The illusion has already broken. Now the market has no choice but to follow.